name is Rajiv Radia. I'm at Whiteford, Taylor, and Preston. We are a full-service law firm with about 200 attorneys up and down the East Coast and 14 offices in Kentucky. We're rapidly expanding, so I have to keep track of how many offices we have and where they are. But so while Whiteford is new to NIBA and this industry, I'm not. I have worked with and for a lot of the people that are in attendance at this conference before, including Ross here. And by the way, I have to stop and I'll just tell you, nothing has resonated with me more than what Andrea was saying about stepping outside your comfort zone. Standing up here right now, and Ross walked up to me when I was standing outside, and he said, "Are you nervous right now?" And Ross always calm, cool, and collected, and I said, "Yeah, sure, a little bit." Get that out of the way. In any case, all right, so we are here to talk about the digital asset strategy. I think a lot of people have heard of it, including myself, but until I started working in it and working on transactions related to that, I had no idea what it meant. I knew that companies were acquiring crypto. I know MicroStrategy was doing it, right, on a larger scale, I think initially, and it spread. So we are here today to hopefully clear up some of the misconceptions, some of the clarify some of the structure of it, and we're going to use Ross Carmel, partner at Sichenzia, Ross Ferrence, Carmel, is one of our panelists as an attorney. Amanda Hackel is a vice president at RF Lafferty, an investment banker who has participated in several of these offerings and other offerings as well. And then we have Armando Soto, who is the CEO of Pegasus Hill Group, which is a family office. So we get the investor's perspective, and he will be joining us shortly. I think he had to step out for a moment. But having said all of that, thank you all for being here. I will go ahead and just start off with Ross. Ross, tell us from the legal side, what motivates companies to pursue a crypto treasury strategy? And what's the first legal regulatory step that they need to get right?
Sure, my pleasure. Nice to meet everybody. Ross Carmel, Sichenzia, Ross Ferrence, Carmel. What motivates you to do a crypto strategy? Well, we actually did the first ever outside of MicroStrategy for a company called DeFi Development, which used to be Janover. What happened there was a couple of former Kraken guys came in. They wanted to mirror what the MicroStrategy folks did, but rather Bitcoin, they chose Solana. They came in, they took over that company, they raised several $100 million. Stock went from $4 to $210 in a matter of weeks. Why is that important? Why do companies want to do it? Because it's an asset on your balance sheet, and it's an appreciating asset with potential upside. So particularly when you're dealing with micro-cap companies who, whether you're a biotech, whether you're a technology company, whether you're a fintech, putting assets on your balance sheet, whether that's coin, IP, etc., is just more attractive for investors. It gives them more upside potential in your stock.
Yeah, excellent. And Amanda, from the banker's perspective, which kind of companies are best suited for this strategy?
So I think there's a few different types of companies that look to implement this type of strategy. We've seen really large pipes done to really transform the business and kind of adjust the core focus of the business into acquiring a cryptocurrency. And then we've seen other businesses with a strong operating core business who are just looking to add a token to their balance sheet and kind of provide some of their investors and shareholders with the opportunity to diversify. So I think it's a few different buckets of companies. I think for the former, where it's a really large pipe and a transformational strategy, it's best done with a very clean company. So minimal cash burn, minimal convertible notes or warrants or anything that would put pressure on the stock, just to allow the stock price to appreciate as the company acquires digital assets.
Yeah, that makes sense. And Armando, as an investor in companies like this, when you see a company announce this, what makes you say yes and what makes you walk away?
Well, I invest in these companies, but I also put the deals together. I introduce the foundations or the investors to public companies, just to give a little bit of background. What we're looking for in the public companies are typically, we want to get to a calculation of market net asset value of 1 or less when the deal gets priced. And that's usually what brings a multiple of net asset value into fruition once the deals are announced. Now, there are 3 different types of deals that are getting done. Some of them are what are called foundation deals, which is the cryptocurrency or digital asset foundation is putting together a deal, and they want to sort of reverse merge into the pubco. You have deals that are being put together by the asset manager, so the investors, these are crypto hedge funds, they want to do this deal because they want to manage the assets that are bought with the money from the pipe. Now, these are typically the deals that an investor in the open market would want to stay away from because all the yield that is being generated from managing the asset is being essentially reaped by the asset manager. And then you have a third type of deal, which is the public company decides to go out and buy the cryptocurrencies from balance sheet cash, or they want to raise capital and buy it, and hopefully in hopes that they would get a multiple of MNAV. As an investor, we're seeing that 10-figure and 12-figure hedge funds are coming into the space, and the reason why is because they're Delta One funds that are shorting a stock and buying the coin down to a party of 1. So these deals are not getting sort of the big oomph that they used to get. So in order to look for those deals that are really going to have that jump in valuation once they're announced is usually the MNAV calculation. So no debt on the balance sheet, we want cash on the balance sheet, and we want the multiple and net asset value to be 1 or below 1.
Excellent. Can I get the mic? All right, so that makes sense, and that's kind of an overview. Hopefully that gives you guys an overview of what kinds of companies can do this, what are the banks looking for, what are the issues that can come up. Ross, once you get one of these deals started, can you walk us through kind of the governance mechanics, like what happens? Because I know, when a deal starts, it just goes, like I'm sure the people, as an attorney, we know what to do, right? But for the company, it can be kind of, I'm sure it's kind of a documents flying at them, and they don't know, they're signing things, boards signing things, what's going on? So tell us a little bit about that.
Sure. I mean, it's a big question, right? And I'll try to kind of narrow it down. Is when someone comes to me with that they'd like to do a crypto strategy or a token play, a lot of the structure is driven upon the NASDAQ vehicle, right? I try to say there's 3 ways to do it. There's the DeFi development way, where you have a foundation or investors come acquire a controlling share block of the company. They come in, then they raise the pipe. There's the NACA way, which was like a full-blown reverse merger, S4, much longer process. And then you have like the UPEXI way, where you have a bunch of shareholders who are coming in, raising capital with the use of proceeds for the coin. For your board of directors, for your management, right, everyone always wants to talk about risk. And that's really on a company-by-company basis. It's also on what coin do you plan on investing in, right? There's level 1 coins, there's level 2 coins, there's level 3 coins, right? It's pretty clear that Bitcoin is at least deemed to be a currency. Some of these other coins, whether it's a TON or a Dogecoin, right, they may be considered at some point, not today, a security, because the law is not clear yet, as Congress is still going through those mechanics. So you need to be mindful of, okay, let's say your strategy is, hey, we're going to buy a whole bunch of Doge coins. Doge is a meme coin, right? That's what it's known to be. There is a potential that the regulatory environment turns the next 3, 4, 5 years, and Doge is now considered a security, and now you're an investment company, right? Which could be a problem from a corporate governance perspective. So when you're evaluating when you're evaluating the strategy, when you're evaluating whether you want to proceed forward with one of these transactions, you want to look at the coin, you want to look at the foundation involved, and you want to look at the investors involved. There's lots of investors that will give you money to use the use of proceeds to buy your own coin, but the most successful transactions are the ones where the foundations are involved, they are long-term holders, they are long-term players, and they believe in their particular coin.
I appreciate that, and you You may or may not have taken my next question for Amanda, but maybe, Amanda, if you have anything else to add. The question was going to be, how are these transactions structured in practice, right? So are we talking about tokens? Are there warrants involved? Are there, any other fees that are involved? Like, what does it look like?
Yeah, so we've seen most of these transactions through, just an issuance of common stock rather than including warrants or anything like that. Most of the transactions are priced at the market to, avoid any kind of regulatory concerns and allow the company to issue, an outsized amount of securities relative to their market cap. And then, on the back end of that, the ATM, so an at-the-market facility, behind one of these strategies is really critical for companies to issue securities on a continuous basis to, buy additional tokens. The ATM really becomes a core component of the company's strategy and ability to expand their token reserve.
Sure. And Armando, as you put these deals together or you're investing, whatever your role is in the deal, what kind of red flags do you guys look for that might pop up with a company, or what do you guys try to avoid, I guess, from your perspective?
The biggest one is usually off-balance sheet risk. One of the first questions that we ask are, does the company have any regulatory inquiries? The most obvious ones are, you can find in the filings, but sometimes companies are going through an investigation or an inquiry from the SEC that they might not have disclosed in their filings, and that usually, kills a deal. And you'd be surprised how many companies out there look like great candidates, but that's the biggest red flag. The other one is usually the warrant overhang. If there is some sort of warrant that's structured in there, we want the warrants to be at least anywhere between 50% to 100% out of the money, and the warrants can be any of the kinky warrants, so to speak. Sorry for the negative connotation there, but that's really what they are. That's mostly what we look for. Low market cap. Any company that on a fully diluted basis, the market capitalization is over $10 million, it's not going to work. A lot of foundations and investors now, they have this new part of their criteria that they want less than 3 million shares outstanding. And the company has to be shelf eligible and all that good stuff.
Yeah, thank you. And I may need to work in this industry a little bit longer. I've never heard that term before, but that's I like that, actually, kinky warrants. Anyway, Amanda, the big question here, where do the bankers make their money on these deals?
I think it's through a variety of different things. As a placement agent, you typically charge a cash fee on the amount of capital raised. In some transactions, investment bankers will also receive warrants as compensation. So that's another opportunity. And then on the ATM side, as a sales agent, a banker will charge a percentage fee on the amount of capital raised as well.
Sure. Armando, where's the upside for investors on this? Is it the token appreciation? Is it improved liquidity? Like, what is it that's an advantage for investors with these strategies that's over, let's say, the typical operating company?
Is it the open market investors in the secondary? Or
yes.
Okay, so that's a loaded question, but I would look for companies that are doing management of their own assets, not companies that are putting the assets in a bankruptcy remote entity that's being managed by a third party, because ultimately some of these foundations or some of these investors are looking to do what we call circular transactions, where they're essentially using the capital markets to raise capital in order to buy digital assets that they can manage and they reap all the rewards on. And essentially the investors in the open market get holding the bag, and they can't figure out why the stock is trading below the net asset value of the asset that they're supposed to be managing. I would look for the clear winners are Bitcoin, Ethereum. Solana is just a hyped up coin in my opinion. A lot of people don't know, but JP Morgan and BlackRock decided to build their real-world asset tokenization platforms on top of Ethereum. So Ethereum will be a clear winner. If you have a company that holds Ethereum and is doing an Ethereum treasury or Bitcoin, those are good ones. And blockchains that have real-world use cases, those are going to be the real winners. That are not burning a lot of money and are actually generating enough yield to keep the lights on, keep their listing on, and won't be deemed a 1940 Act company at one point or another, because a lot of regulators are really going through these deals to make sure that it looks like a 34 company and not a 1940 company.
I appreciate you bringing that up, because that goes right into my next question for Ross. What are the biggest legal or regulatory risks that you worry about with these? SEC scrutiny, exchange rules, governance gaps, et cetera.
Yeah, I mean, I touched on it briefly, like Armando mentioned about becoming a 40 Act company, which really restricts your corporate governance abilities. But, the other things that we're seeing now is both NASDAQ and New York Stock Exchange are kind of giving guidance on their rules. Like, really good example, I was talking to Jay Heller the other day, head of capital markets at NASDAQ, and they have a proposed rule that will likely come into effect shortly, that they'll be announcing, where they're going to be talking about the fact that if you're going to be contributing coin in these private placements instead of fiat currency, then they're going to require shareholder approval. Similarly, the New York Stock Exchange has what's called a change of business rule, which is different than a change of control rule. But the change of business rule talks about, well, if your business is changing, meaning, hey, you're a biotech company, but now you're an asset management company or a cryptocurrency company, that requires shareholder approval. So, and I think, right, to be determined, we have a very crypto-friendly administration in place right now. Certainly that could change in 4 years. So I think, things are still to be determined, could be up in the air, and we have an ever-evolving regulatory environment.
Okay. Yeah, no, that makes a lot of sense. And so that covers the actual regulatory risk, right? Amanda, tell us about, there's regulatory risk and then there's perception, right? Investor perception. So how do you guys help companies position the story to, alleviate concerns of investors?
Yeah, so I think it's important to really have the right team. I think if it's a consumer products company that's all of a sudden going to be acquiring $300 million worth of a token, it would make sense that there would be some management changes and some experts to really come in and advise on what those purchases look like, advise on raising capital to fund those purchases going forward. So I think that's really important, right? You want investors to trust that when you are transforming or changing the core business, that there's the right team of professionals to do that in a responsible way. And I also think investor relations is really important, and just communicating with the public on the company's strategy, efficiently communicating on ATM share issuances and the company's strategy. So, I think all of that is really important to investors and to investment banks, just to make sure that there is that right team, because it is a big transformation. It's a big change. I think we're still kind of in the infancy of this strategy, so you just want to make sure that companies are being transparent and being strategic about these purchases and how they're integrated into the company's business.
Excellent. And Armando, I'll let you add on anything that you'd like to that as far as evaluating whether management is sophisticated enough to manage this strategy. Is there anything else that you would like to add to what Amanda said? Because I know she referenced, adding management or adding people who are, at least experienced, but are there anything specific that you would look for?
Well, it really depends, because all the management of the treasury is really being done by third parties in most of these companies. What I would like to see is a company that manages their own assets, so they're not paying yield to the custodian, because they can self-custody the assets, and they're not paying a management fee to an asset manager, because it's not rocket science to bring people in the house and do the asset management in the house. So a lot more yield could actually be generated. So we've yet to see a company that does a treasury and also runs either some sort of a node, if it's a proof of stake company. We have seen the mining companies, but that's really more proof of work. So the proof of stake is really early in its infancy, and it's something that requires a certain level of sophistication. If somebody runs a toy company and all of a sudden they decide to do a $300 million deal to manage Ethereum or Solana, your average manager doesn't know how to manage these assets. Additionally, one more thing that I would like to add, the big banks are looking at making digital assets like Bitcoin, Ethereum, Solana, and some others, to deeming them a balance sheet asset so they could actually write derivatives around and use in ISDA contracts. So that's really going to create a feedback loop where the prices of these digital assets are really going to increase in the next cycle.
Great. So this might be too early to ask, maybe not, maybe it is, but how has the market responded so far? And I'll let either of you guys, whoever wants to take it, but exchanges, analysts, investors, you guys hear things, you guys speak with people. Any insight into that?
Yeah, I mean, listen, I think 6 months ago, the markets were going through the roof on any crypto deal that you announced. That has changed. Now, the ones that are really working, and I think this was to Armando's point, are the ones that have real foundations behind them, that are not outsourcing their asset management strategy. They're bringing it all in-house, and they're taking control of these vehicles. Those are the ones that you're seeing that have the greatest appreciation in the share price for any of your average investors.
And just adding to that, I mean, we have a retail client base as well as an institutional client base, and I think, we've seen excitement from both sides. Obviously, the institutions are sophisticated, and so they're thinking about things like derivatives and hedging, but for the retail investors, I think they're just really excited to have the opportunity to participate and get some exposure to cryptocurrency in a way that they really otherwise wouldn't. So I think it's really exciting, for both the retail and the institutional client base.
Great. Armando, do you have anything to add there? Anything to add on that, or I don't know if you had anything else to say on that as far as reactions that you're getting from investors or anyone else that you're speaking with?
Yeah, everybody's asking me how do we find the company that's going to do a treasury deal, and I would say look for unusual volume in a company that trades by appointment only, and 5 out of 10 times that those companies are doing a deal the following week.
Yeah, no, that's good. Ross, do you expect, and we've already covered this a little bit, and no one's got a crystal ball, and we know the administration, they can be back and forth. They've been very, set on promoting crypto, but do you expect any regulatory clarity in the next, 1 to 2 years that make it either easier or harder to execute these deals?
Yeah, no, absolutely. I think obviously we saw the Genius Act earlier this year, which I think was a huge step forward for the industry in general. Paul Gensler at the SALT conference, a couple of weeks ago, was talking about his focus on crypto and what they intend to do. So I do think probably over the next 3 years, while this administration is in place, we'll get additional clarity, not only from a congressional level, but also from the SEC.
Excellent. Amanda, do you have anything to add there, or your any thoughts on that as far as getting these things done? And are you guys seeing? Here's a question for you. Actually, is from the first deal that you guys did, whenever that was, till more recently, have you guys seen any difference in the speed at which it gets done, the reaction that you've gotten from investors and other folks, any other stakeholders?
Yeah, I mean, I think there's a lot of excitement around what's been going on, and so we've seen, a lot of our public company clients kind of come to us and say, I've seen 3 of my competitors implement this type of strategy, and I'd like to see how I can participate. And so, I think we anticipate that it'll continue, but as Ross mentioned, it is a changing regulatory environment, so you always want to be careful. I think the in-kind contributions that Ross mentioned are something that you want to be super careful about. For a recent transaction we worked on, we didn't have any in-kind contributions just because we wanted to avoid any potential regulatory hiccups in the future. So, while we don't have a crystal ball, I think it's always good to be conservative, make sure that you have the right legal counsel and are making the right disclosures just to avoid, as the changes come, to try to safeguard against those for investors.
Sure. That sounds good. And here's a question that maybe I could have asked earlier, but maybe provide some more clarity to these deals. But what happens to the operating business of these companies once they've implemented the strategy? Do they continue on? Or are they, are
They
spinning
continue
off?
on.
What's going on with that?
Yeah, I mean, they continue on, and there's a bunch of reasons for that, but one of the main reasons is that if they didn't, that company would be deemed a shell, which then would devalue the public company, obviously could result in delistings, and could also result in losing S3 eligibility. So typically what you're going to see is that if you're a biotech company that raises $500 million to buy Solana, that biotech business will continue. And some of that use of proceeds, a small part, might be used to continue to fund those operations, because otherwise you'd be a shell company.
Yeah, no, thanks for the clarity on that, because I think, I talked to a lot of people and they asked that question. I thought, I'm sure there are people in this room that might have that question. I don't know, but it's nice to shed some light on that. But so as far as the panel goes, I will give you guys one final thought, and then we can take some questions to the extent that anybody has them. Armando, I'll start with you, but if a CEO in this room is considering a crypto treasury strategy today, what's the one piece of advice that you would give them?
Well, I would say...
Just one, by the way. You can't give any more than one.
Okay. Make sure you get a parachute.
That's fair enough. Amanda?
I think assemble the right team. Make sure the right professionals are behind it. If it's not a CEO's area of expertise, get the right advisors, get the right placement agent, make sure that the story that you're communicating to investors is clear and understandable, and, just make sure that you have the right team surrounding that.
I think you need to do a really hard look at your business, right? Are you a, unfortunately, failing biotech, or are you a thriving fintech? If you're a thriving fintech, don't muddy your story. There's no reason to. You're doing well. Continue operating your business. Go for your goal. If you've realized that maybe you've reached the point where you can't raise enough capital to fund, whatever clinical trials you're looking to do, then maybe for a fiduciary duty standpoint and for the good of your shareholders, you should think about doing a DAT strategy.
Excellent. Thank you, guys. Any questions out in the audience here? Yeah, sure.
Ross, can you go into more detail? Something like a Bitcoin like Doge is considered security. Why is that banned for the public issue?
So we don't have detail yet. That's the whole idea. We don't have clarity as to whether Doge, for example, would be considered a security or a currency. The law currently is unclear. Congress hasn't passed any regulations about it. I think what you see, though, is, right, Bitcoin can be used as a currency. You can use it to buy and sell products. There are Bitcoin ATMs in which you can withdraw money from. You can, lots of companies nowadays accept Bitcoin. Other than Elon Musk, it's very rare that a company accepts Dogecoin, right? You have the Trump meme coin, right? I don't know a business that accepts that. So it's really going to be on a coin-by-coin basis to determine, hey, is it a currency? Is it a security? And unfortunately, if it's deemed a security and that makes up more than 40% of the assets in your balance sheet, you will be considered an investment in that company.
Right?
I've seen a lot of interesting with tying the blockchain. I haven't heard the word blockchain too much, but the token be tied to a blockchain of different products. Some ideas that I didn't have, how like IP or art, if you want to rent a piece of art, and you got to use tokens for it, how it's tied to blockchain. Whoever can answer that, okay, Armando.
So that's actually a great question. We did a $360 million deal with a company called Cask to place a Story IP coin, and the Story Foundation is behind the coin. And essentially what that particular blockchain does is it's looking to secure the $80 trillion IP economy. They're backed by Andreessen Horowitz. They were the biggest investor in the pipe. I can't really talk about the deals that they have going on, but if you look at what they're doing, it's really, really interesting. And I hate to say this, but in the future, there will be no investment bankers, there will be no attorneys. Everything will be done on the blockchain through smart contracts, and all the dealings that humans will have will be done by AI agents, and the contracts will be done through smart contracts. But that's probably 15, 20 years from now, if we reach that type of utopia. But to your point, blockchain is the underlying technology that secures all of these digital assets.
Yes?
What are the yield strategies you're seeing in the market today? Like dialectic, are there other strategies that you see in the market?
What, do you want to take this, or do you want to take that?
There are asset managers that take delta neutral strategies. You could generate anywhere between 8 to 12%. If you want to take a little more risk and do a delta 1 type strategy where it's really arbitrage, but you're taking counterparty risk, you could generate anywhere between 12% to 28% on the sort of conservative side, but you do have the counterparty risk. Counterparty risk is you're trading with exchanges around the world, but if one of those exchanges gets hacked or they go out of business and your assets are there, then you run into trouble. But there is a lot more quote-unquote alpha to be found in the digital asset markets than there is in the traditional capital markets, bond markets, derivatives markets. And Citadel is actually building nodes to get into generating alpha in the digital space. So that eventually all of that arbitrage and all that yield that is being generated, it'll go down to somewhere between 5 to 10%, but there's a real opportunity there now because it's so early. It's in its embryo stage, as I like to call it. So for the next probably 3 to 5 years, there's an opportunity to make a lot of money, but you have to have a level of sophistication on the security side. That meaning making sure you don't get hacked in order to generate those types of returns.
Great. Thanks, Armando. Yes, go ahead.
Yeah, could you comment on funding companies in addition to the Treasury and the whole opportunity where companies can fund new opportunities in real world assets, tokens, RWA, the Stablecoin Act, which you mentioned, the stablecoins which are now legal. Just a few months ago were not legal, we couldn't fund. The funding is so much quicker, so much, everything's moving much faster. There's so many reasons why the technology is just light years ahead of the old systems that we use. And so I think fractionalizing real-world assets, portions of companies, raising capital with for companies, different parts of the company, you mentioned medical companies, that becoming a real-world asset or tokenizing something as a real-world asset is a whole other way to raise capital without giving up equity. You're giving up shares in tokens, so you're not giving up equity. So it's a whole other thing that's happening now, and I think it's something that companies are very interested in learning more about.
Yeah, go ahead. Is there any, which one of you guys feel like taking that one? Yeah.
For sure. I think that's going to be the next evolution that we see. We run a company public called StreamX. They're tokenizing gold, right? Real world, hard asset. And I think you're going to see more of that. There's real estate companies popping up. They're doing these RWAs. There are art popping up doing these RWAs. So I think what you're going to see is that the next evolution outside of the cryptocurrencies are these real world assets being tokenized, sold in order to provide you the appreciation and upside on those assets.
Any other questions from anybody? Any questions not related to digital assets? Any questions related to NIBA? Cocktail receptions, dinners that are after?
I get a quick one here.
Yeah, go ahead.
I seen, you have your standard board. The board is now selected, go digital. Then there becomes an advisory board. It seems like the whole advisory board, which is, as Armando said, is the smart people that knows the technology, they know where it's going. Should shareholders, retail shareholders, see that as the transition? And I'm assuming going forward they pretty much run the company. This advisory board until your 9 months, 3 quarters, 4 quarters is over with, and then you'll see a change. Is that pretty much the way it's going to go? Because we're in that phase now where most of these things happen this year.
Right.
And we got another 6 months to see what's going to happen.
So it depends on the company. It depends on the crypto strategy that took place. It depends on how that was structured. But for the ones that are bringing on those asset managers and the advisory boards, yes. In 6, 9, 12, 15 months, you could expect some of those operating businesses to subside, probably, and that these guys who are the crypto folks will be running the day-to-day operations of the company.
Think there'll be a lot of spin outs of those assets?
Yes.
What as a follow-up to that, like what other, where do you see it going, right? There's a ton of companies that are implementing this strategy. What happens, let's say, in 2 years, 5 years from now?
Well, listen, I think it's a bit of a bubble. I think that bubble at some point will burst. I think that you're seeing that these strategies are not trading like they used to. Like I gave the example, right? First deal we did went from 4 to 210. The last deal we did went from 8 to 16. Awesome, right? It doubled. But it's come down significantly. So as more of these strategies hit the market, eventually there's going to be less appetizing for investors. You're going to have less appreciation of the stock. And at some point, investors will lose interest in putting money into these companies.
All right. Any other questions?
I hate to say it, I got another one. How do we value, I'll ask one. How do we value these companies? Because I think that's the biggest thing as a retail person, don't know how to evaluate these things. How long do you think it will be before there's no analyst, as far as I know, that covers hardly anything that's been digitalized yet that I know of?
They're essentially worth the asset that they hold minus the burn. That's really what it is. I mean, it's become an arbitrage game. That's why you don't see those 10x pops in one day.
How they can use those assets to create yield?
Well, the asset manager or the custodian is the one that's generating all the yield. The company gets crumbs from that. That's why my previous comment was, if the companies were managing their own assets, if the companies were custodying their whole assets, there would be a lot more upside, because there's actually a cash flow generating business that could either buy back stock, or it could buy more of the digital asset that they hold, as opposed to just continuing to print stock. Eventually, your float gets so big that, is the stock really going to run? I mean, there needs to be a really, really big gap between the asset and the price of the stock in order for the stock to run. And we live in an equity market where you have machines that read every press release, every filing, and those machines are 20 times smarter than we are. So there's a reason why that stock doesn't trade at a multiple of whatever coin it is that they hold. And if you look hard enough, typically you find the reasons why. Unless the market doesn't understand the deal. If the market doesn't understand the deal, then there's certainly an opportunity there. And there are opportunities that arise every day in the market. But as it is now, the companies are worth the digital asset they hold.
All right. Any other questions?
I got one last question.
Yeah.
The foundations, are they being part of are they going public to finance kind of like the miners of their tokens?
So they're, honestly, in my opinion, they're going public because they've realized that it's a great way to raise capital in order to invest into the coin in which they're the foundation of, right? So if you think about it just generally, let's say I'm the foundation for Solana. I probably own 1 million coins of Solana. It's probably not such a bad strategy to raise capital in the public markets to invest in Solana, thereby appreciating the Solana asset, thereby appreciating my holdings.
All right. Any other questions? Okay. All right. Well, thank you guys, Ross, Amanda, Armando. Appreciate everything, all the knowledge that you guys provided. Also, a big thank you to NIBA for allowing me to moderate this panel with these, brilliant minds up here. And Andrea for, talking about getting out of your comfort zone. I don't think you were in the room when I talked about that when I got up here. And so I'm a lot more in my comfort zone right now, and I promise I will stop talking in about 2 minutes, but just wanted to give a thank you to NIBA. Jim, Hawk, Carlo, thank you guys for allowing me to do this, and hope you guys enjoy the rest of the conference.